We talk a lot about real estate investing, but can you be a passive real estate investor and get great tax advantages, which will accelerate your wealth faster? That's what we're going to talk about today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you if you want to become work optional, where you want to have enough passive income to work because you want to, not because you have to, but not just trying to do it to get rich, but you want to live a rich life because as you have greater financial and time freedom and greater capacity, greater resource, you have the greater ability to bless the lives of those around you. And that is exactly what we're here to do today because I know you want to work because you want to, not because you have to. And so shout out to all of you guys, especially I know many of you have been following us now for over 11 years on this show. Thank you for being such faithful, loyal listeners. And thank you so much for spreading this ripple effect in the lives of others too. If you always have questions, be sure to check out moneyripples.com because not only do we have a revamped website with new FAQs and everything else, but you got to check out, we've got so much more information for you to help you on your financial journey to get to financial independence faster. So be sure to check that out today. Okay, on our show today, I'll have Jason Melillo joining us. Now, I get pitched all the time for different guests, but I'll tell you from seeing his background and seeing the fact that he's had a tax background for really like 25 plus years in this industry, and knowing the real estate space so well, I knew we had to bring somebody on for this because here's what I hear all the time from many of you. You say, okay, Chris, I can see that people are trying to become active real estate investors. And yeah, they get all kinds of tax write-ups as a business owner. You can even become a real estate professional. And yes, you could do that. But again, you're still spending 750 hours plus a year. Well, Chris, what if I don't want to become a real estate professional? What if I don't want to spend that much time because I don't have it or I just don't care to invest that much time? What can I do to get the best tax advantages in real estate investing? That's exactly what we're going to talk about with Jason today. So, Jason, welcome to our show.
Thank you. It's great to be here.
So tell us a little bit more about how you even got into this path, because it seems like you had a kind of an interesting nonlinear path to get here.
Sure. So, I've been a CPA for 26, 27 years. And early in my career, we learned about a tax benefit called cost segregation. And
Mhm.
and we serviced lots and lots of business owners. And certainly one of the things that comes with business owners and wealthy individuals is real estate investing. And cost segregation is a way to optimize the amount of tax that people pay by accelerating depreciation on and deductions on their real property. So when we learned about this, it was really something that the big companies took advantage of.
Mhm.
Big four CPA firms were out there and had been doing this for years. And really the middle market and down had never heard of it. It was not something that was widely practiced, and it was brand new. There was a court case in the late 90s in 1997 that kind of opened it up to make it more clear so that it was a little more accessible to investors.
Mhm.
And when we learned about it, we said, "Hey, this is gold here. We want to be a part of this." And so we actually made it part of our business practice. We actually started a company that myself and my partners co-founded to perform this service. And now it's the point where I no longer practice as a CPA. All I do is focus on these types of tax incentives for CPAs and their clients. We're a solution provider to the tax profession.
That's fantastic. Well, it's funny you mentioned that cost segregation because even when I first heard about it, like around 2010-ish, I mean, that was still like a new thing. Like so few people knew about that, especially business owners, where they would have their own building. And man, when we found out they had their own building, especially like chiropractors or dentists and people like that, we would get so excited. We were like, I guarantee you're already overpaying because you're not taking advantage of these tax incentives. And almost every time it was like sometimes we'd save them. Well, I think we saved one guy using a CPA firm, of course, not ourselves, but
Sure.
I think it was like $200,000 from a cost segregation study. It was incredible.
It's amazing how powerful it is because people are already investing in a building because it makes sense, right? If I've got an operating business, Why am I going to pay rent to somebody else? If I have the capacity to pay that rent, why not pay it to myself? Why not buy the
Yeah.
building myself or through an entity that I own or that I own with my family? And then I rent the building to my operating company. And by doing that, I have the best of both worlds because now I can shelter a bunch of income through the depreciation deductions that I'm generating from my business.
Yeah.
And one of the things that uh, the big beautiful bill just renewed was bonus depreciation.
Hmm.
And what bonus depreciation allows someone to do is to take what they could do with a cost seg study and put it on steroids.
Hmm.
Because if we've got a building that we paid $1 million for, and let's say I'm going to just make up a number under regular depreciation, we might get to deduct $10,000 a year, right?
Hmm.
If with the cost seg, we're able to allocate a big chunk of that $1 million building to a shorter life property, that then allows us to take a bigger deduction in the first year. But then
Hmm.
with bonus depreciation, we get to take 100% of that. So if we carve
Yeah.
out 10 or 15% of that $1 million building, we could get a $150,000 deduction in year one
Versus 10.
versus 10. Yeah.
Wow. Yeah,
Don't
I was
test
actually
me
going to
on
ask
that
you.
actual math, but
Mhm.
you get the concept of it.
Right. Well, I was going to ask you that with the big, beautiful bill, right? Which you start to wonder, is it really that big and beautiful in some cases? But I know that's one of the perks, right? Is having that bonus depreciation. My question was actually going to be, is it still worth doing cost segregation when you have this? Or does it kind of take some of the fuel, kind of take some of the incentive to want to do it as much?
Yeah, no, actually, I think it adds incentive because while without bonus depreciation, let's say that $100,000 or 10% example,
Mhm.
we can depreciate 100,000 over 5 years, which is great, right?
Yeah.
Fantastic. But if we can do it over the first year, now it's super powerful because I can go from paying less tax in year one to maybe paying no tax in year one. And I'd rather have that cash flow to say, okay, now I'm going to take that cash flow that I saved on the tax that I didn't pay,
Hmm.
and I'm going to use that to invest in something else. Maybe I'm buying a rental property at that point. I'm taking that money and I'm using it to buy a rental property, which I can then do, guess what? A cost seg on that rental property and shelter the income from the rental property just the same. So,
Yeah.
I would be sheltering passive income on the rental property as opposed to active income on
Uh,
my operating business that I'm renting from. But the idea is if you really want to leverage and utilize your own money efficiently, if you can defer the amount of tax that you're paying by taking deductions now instead of later, then you're able to reinvest that money now and get to retirement, get to that work optional place that you talk about much quicker.
Well, in that cost segregation study, the nice thing is it goes against active income, not just passive income, correct?
Yeah, so it can go against active income when you own a trader business and you also own the building that your trader business is working with.
Hmm.
Uh, it's if it's just a rental property and you're not a real estate professional, then it would go against passive income. So
Right.
if you have multiple passive properties, and this is really common, right? You have a taxpayer, they may own, two or three uh, rental properties.
Hmm.
So if they have income flowing through from properties one and two, and they're getting taxed on it, and they buy property three and they do the cost seg on property three, now they're wiping out the income from one and two, assuming that they've already depreciated one and two. Sometimes
Right.
people have held a property a long time. They get through their depreciation, and they're just like, now what? I've got this cash flow, but I don't have anything to protect it and shelter it from tax.
Correct. And so sometimes it makes sense to do it where I could tell in some situations, depending on their passive income, it just, depends on whether or not you want to take advantage of it, right? Or can you just keep passing along year after year?
Well, again, if you're passive and you want to shelter passive income, if you already had enough depreciation to shelter all of your passive income,
Hmm.
there'd be no need to do the cost segregation study in that year. You would
Hmm.
wait until you get to a point. And this is one of the things that's great about cost seg is the versatility of it. You can do it at any time.
Hmm.
So if I don't need it this year, I could literally wait until the following year or the year after until it's necessary or beneficial for me to use it. Because sometimes when you buy a property early on, maybe you're doing a lot of repairs and upgrades to it, and your interest rate is, or your interest deduction is a little bit higher.
Mhm.
So I may have enough where I don't need to do it the first year or two that I own the property, but now I've stabilized the rent, I'm getting the cash flow coming in, and gosh, I don't want to pay any taxable income if I've got a way to shelter that. That's what the
Mhm.
cost seg study will do for you.
Now, I know some people would be asking this question because, they might not just have rental properties, but they may also be lending. They might have notes that they're doing, right? They might be doing some real estate lending. They might have other investments. Maybe it's a syndication, right? Maybe they're in apartment buildings or something like that. What would happen with them? Like, is there any way, because they're obviously earning income over there, is there any way to offset that income over there too?
If they were not a passive income investor on that property, on the rental property, if there was a
Right.
way to make them active, then they would be able to offset their interest income from the notes that they have on their other investments. And
Mm,
I think you and I had a brief conversation about, the problem with the real estate professional, if it is a problem. I
mhm,
think from this one standpoint, it's a great place to be if you can get there, but you
mhm.
do have to meet the 750 hours rule, in order to qualify for that safe harbor. If you spend more than 50% of your working time managing and operating that real estate, and you meet that 750 hours, then you're able to take whatever losses you generate from your real estate activity and offset that against ordinary income from other investment activities.
So to kind of clarify, when we talk about the real estate professional, tax status, essentially you're becoming a business owner, you can actually show a loss, which can
That's
go
right.
against your active income, correct?
That's
Versus if
right.
you don't, if you just have normal rental properties, you can only like you said, depreciate to the point where you get down to zero, but you can't show a loss,
Yeah,
and that's the big thing I know a lot of our clients are looking for is how do I offset even my active income too?
that's
So
right.
let's talk about the real estate professional status, right? You said 750 hours. I know that overwhelms a lot of people. Are there creative ways to do it where it doesn't feel like it's literally spending 15 hours a week, right, over the course of a year?
Yeah, we're not talking a
Or-
lot of time, right? I mean,
Yeah.
really, most of the real estate professionals I know, that's about how much they work, regardless of how many properties they own, right? They're able to manage their properties efficiently,
Mhm.
um, and really, the leverage that they get from whether it's one property, two properties, 10 properties. Yeah, you're spending a little bit more time, but certain things, you have a minimum threshold that you're reaching, and then after that, there's some economies of scale.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
But ultimately, that's the place you want to get to, is to that real estate professional status. Now, there's other who generate active, like a trader business
Mhm.
from, uh, let's say you have a second home that you rent on VRBO. And if you are averaging 7 days or less on the rental stays throughout the year, and you're not staying in that property more than 14 days or 10% of your rental days, then that actually becomes an active trader business, and you can show a loss on that and use that to offset against ordinary income. And I think, when you look at somebody who's maybe starting out, they don't have 10 properties, 10 rental properties that they're managing, that they, easily meet that 750 hours rule. Here's maybe a way to get there. If they've got yet a second property that they said, hey, I want to have this investment property, that might be a way for them to get there and utilize that to create some nice tax deductions that they can offset against their W-2 income, and make
Mhm.
it easier for them to get that next property and the next property after that.
So you said 7 days or less that it's rented. Is that correct?
Yes, on average.
On average. So it
Yeah,
can't
so
be more?
you could have a 14-day rental,
Mhm.
but then that means you need to have some shorter term rentals in there to mix in so that it brings the average down.
Oh, I got you. It's like so then the number of days stay, not 7 days total that
That's right.
all the bookings are. Gotcha.
Yeah. Yeah. I mean, it can be rented 365 days a year.
Mhm.
And as long as the number of, if you've got 52 renters, that gets you at 7 days, right? So
Mhm.
if you, if you only had 51, then you would be above that 7 day average over
Right.
365.
I gotcha. That makes more sense. So I kind of compare this, and I mean, this almost reminds me of the movie My Cousin Vinny. I don't know if you've seen that movie
Oh
or
yeah.
not,
It's a favorite.
but like when the guy owed him money, and he's like, "Here's your money." He's like, "How do I know that's not just a 20 wrapped around a bunch of ones?" He's like, "It's there." Then he punches him, of course, and then he gets the money, counts it. He's like, "Give me my money," right? It kind of reminds me of that. Like it's almost like that VRBO is like the $20 bill wrapped around a bunch of ones. So you could have a couple of, let's say turnkey raw properties where you're not even property managing it. You might be involved, obviously, in that point. I know they count hours when they talk to you as a CPA, right? I mean, they could do all kinds of things that way. But it sounds almost like if you have that VRBO, if you've got other passive investments, it could help offset some of the income you're getting from other investments. Is that correct?
Sure. Yeah, it could. Um, and it could help offset W-2 income, right?
Right.
Just the
Hmm.
same.
And that was my big question was if somebody's a W-2 employee, right? They're just working their hours, they get very little tax benefit, and maybe they don't even have another business or a side hustle. I mean, what are their options, really?
Yeah. I mean, that's always the issue that most taxpayers face is what's in it for the person who's just a paycheck employee. There's not a lot of tax benefits out there. Now, to the extent that you have money to invest, that you can create these ways to generate losses. And I,
Mhm.
I won't get into oil well royalties and all this
Mhm.
stuff that goes on with that, but that's another way that people to create active losses to offset ordinary income.
Yeah. Yeah. I know we have some of our clients also do some things with oil and gas where they can actually get
Yep.
some of those tax benefits too, right?
Yep.
And so, so Jason, can you give me an example of like where like some of your clients were able to make this work, and maybe they were still working full time, but they were able to make this work and still not kill themselves in doing it, right? Where they're taking too much time. Like, where have you seen that work for some of your clients?
Yeah. I mean, ultimately, it starts with one property at a time.
Mhm.
Investors always have to start with the first property. Nobody has the money to go out and buy 10 properties all at once, right? So ultimately what you want to do is figure out how can I make this work for me with my current circumstances? If I have taxable income, I'm a passive taxpayer. I want to make that passive income either zero or a loss.
Mhm.
If it's a loss, I can't take it against ordinary income, but I can carry it to next year. And that's okay because next year I may have less deductions and so ultimately all you want to do is make sure that you're getting as much of that cash flow as possible without being taxed on it so that I have that cash flow to invest in the next property. The more I can go to the next property and the next property and continue to have zero taxable income, that's going to give me the cash flow that I need to continue to leverage. And if you're familiar with real estate investing, if I invest 10,000 and I am able to use that as my down payment, and I have a $10,000 loan, so I'm 50% leveraged. I'm making my growth work twice as hard for me because I'm really only putting up half of the amount. Where if I were
Yeah.
in the stock market, I'd have to have a much higher return to get the same benefit that I'm getting from the leverage. But on top of that, I get the benefit of the tax deductions from the depreciation. So I've
Right.
got cash flow with hopefully no tax on that cash flow because I've got that depreciation, especially if I'm able to utilize the tool of a cost segregation study.
Well, and that's one thing I mention all the time is that there's no tax benefits to stocks. If you really think about it, I mean, they try to package them in like, the IRAs, Roth IRAs, whatnot. But I know like my least favorite accountants are the ones that say that IRA will save you money.
Mm.
When all it does is just kick the can down the road, but they still get taxed and possibly at a higher rate down the road, depending on what happens, right?
Right. Well, and I will say with real estate, the beautiful part about that is when we sell the real estate, Yeah, if we sell the real estate and we're just going to cash out, then
Mhm.
we could end up with a taxable event.
Sure.
But if we want to trade out of that real estate and do the 1031 exchange, and if we're truly a long-term investor where all we're going to do is continue to stay invested so that we have that to live on, then we're going to hold real estate until we die. And when we die, we'll never have to pay the tax. And that's the whole real estate game, right? All of the real estate tax laws are really favorable to the real estate investor that wants to buy, hold, keep the cash flow, get the depreciation benefit, do a 1031 exchange so they don't have to pay tax when they trade out of this property into a bigger one. And when
Mhm.
I get to do that, I can create more depreciation deductions for myself, and then and then when I die, my heirs, my estate gets a step up in basis. So my property that I paid 100,000 for that's now worth 1 million or 10 million, whatever it is, my heirs now get that $10 million to start depreciating all over again, which is really a powerful part of the tax code.
And that's my next question right there. I mean, Jason, is it really possible if someone who does real estate investing, even in a variety of forms, right, even if they're doing more passive investments, is it actually possible they could never ever pay tax the rest of their lives on that money?
Absolutely. Absolutely. And I
Incredible.
think that one of the reasons why when President Trump was running for election the first term, and there was a concern about, hey, why don't you want to show your tax return? It was because the real estate is so favorable for real estate investors, or taxes are so favorable that yes, of course, there's no tax to report there, and so that's something that some people might frown upon, but that's the way the law is. And so anyone that invests in real estate, follow the law, and you can never pay tax again in your life.
That's probably, and maybe that's what it was more so than him trying to hide anything, was just trying to hide the fact that it makes his income look so low from all the depreciation, right? That he's like, no, it'll be embarrassing. People will call my bull, think I'm not a billionaire when I only make maybe a couple
Uh,
million a year after
or
taxes are all
or
said and done.
question the fact that how can you be a billionaire and not pay tax, which is
Right.
what I think most billionaires are in a great position where they pay very little tax because of how they structure their investments, their
Yeah.
business, their activities, and where when Warren Buffett used to talk about his secretary paid a higher percentage of tax than he did. Well,
Mhm.
yeah, because he's structured his business in a way that's more favorable so that he gets the most optimal tax rates as opposed to what the average W-2 taxable income payer is. And so, as our example talked about earlier, how do we figure out how to reduce our taxable income as a W-2 taxpayer? There's not a lot of ways to do it, but we talked about a couple of them today.
Awesome. Well, two last questions for you, Jason. I mean, obviously, with your company, you focus a lot with real estate, different companies, real estate investors, even CPAs. If someone wants to follow you or reach out to you, what's the best way they can do that?
So they can follow me on LinkedIn, Jason Melillo, or they can check out our website, kbkg.com. If we have several tools on there. We have something called the residential cost segregation tool, where if someone owns, a single family residence that they rent out up to 6 units that they rent out, if it has a depreciable basis of less than $1.5 million, they can use our tool. If they type in the code Money Ripples 2025, they'll get a discount. And so we'd love to have people take a look at our site and learn more about what we do.
Awesome. That's very generous of you. Thank you, Jason.
You bet.
So, all right, guys. Well, be sure to check that out for sure. Last question for you. This is the Money Ripples podcast. I always ask every guest this. I know you're smiling because you've watched a few of these episodes too. What do you feel is your ripple effect that you're here to create on this planet?
I'm here to help people reduce tax drag so that they can invest and create the life that they want to lead. Really, ultimately, that's what we love to do.
Yeah. And why is that so important to you?
Just because I have this knowledge that I'm happy to share, and it's what I've learned over my career, and why shouldn't um, the average person figure out the same thing that a billionaire can figure out to minimize tax?
That's so true. Well, great. Again, thank you for your time, Jason. This is
Yeah.
wonderful. Great content. I know it's probably got a lot of wheels turning already. So So again, guys, if you want to reach out to Jason, we got the contact information on the site, whether you want to go to LinkedIn or just go to his website, especially if you want to try out that residential calculator. That's a pretty cool thing to see what you can do with the cost segregation study. So anyways, guys, remember, you can listen to these episodes all day long, but the question is, what will you do about it? So go and make it a wonderful and prosperous week. We'll see you later.